Marriott is a worldwide operator, franchisor, and licensor of hotels, residential, and timeshare properties, conducting business in the hospitality industry. And we are Susan Brooks and Marco Ling, analyzing Marriott. Marriott's business strategy is what they call an asset-light business model, whereby they focus on managing, franchising, and licensing properties under the Marriott brand names rather than owning real property. They actually only own less than 1% of their managed properties. They specialize in management, franchise, and licensing services for 30 distinct brands across more than 6,900 properties. What does that look like on Monday morning for hotel owners? Hotel owners can expect to pay a base fee of 4 to 6% of room revenues and 2 to 3% of food and beverage revenues for their full-service hotels. Whereby they're allowed to use the Marriott brand names and Marriott systems. And they receive management incentive fees. Marriott is reimbursed for all the costs of operating a hotel. They hire, train, supervise managers and employees. They purchase supplies. They provide centralized reservation services, advertising, marketing, and promotional services, as well as accounting and data processing services. They have a brand portfolio that they have licensed all over the world. Marriott has built revenue per available room greater than any other. Their key success factor is by doing what they do well. They manage properties and take care of guests. This has earned them the highest revenue per available room rate of any of the brands in the world. They distinguish themselves by taking care of guests in such a way that guests give preference to the Marriott brands over other brands. Marriott has also discovered that they are great at building systems. They have online reservation systems and accounting systems for the hospitality industry that are world-class. Their key competitive advantage and how they distinguish themselves is by relentlessly focusing on these key success factors, taking care of customers and offering up-to-date, nice hotels, and developing and perfecting operating process systems. Of course, they don't operate without risk. Marriott is exposed to seasonality. People travel certain times of the year, and their properties will see greater number of customers certain times of year and lower others. They operate in a highly competitive industry. In the United States, 71% of hotel rooms are brand affiliated, and Marriott is not the only brand competing in that market. They are also subject to economic downturns and federal spending cuts and government shutdowns. With a third of their rooms growing outside of the United States, they have also opened themselves up to international currency exchange rate fluctuations and the ever increasing and complicated international business laws. They are also experiencing risk related to natural and man-made disasters, property damage, and capital markets being available for funds for owners of the hotels to develop and refurbish the properties to stay up to Marriott standards. And finally, they have also experienced risk of the quality of the labor pool that they hire. They have put themselves at risk by acquiring the Starwood Hotel brand. That has consumed a huge amount of their management and internal resources. They can also lose contracts for managing hotels and be exposed to litigation costs of upholding those contracts. They can also lose goodwill because of the reputation of franchisees and licensees. And they also have tax risk. Just alone integrating the Starwood hotels costs them huge amounts of money to overcome a data breach that cost them greatly in 2017 and 2018. It was with a great payoff because by acquiring Starwood Hotels, they became the #1 biggest provider in the hotel and industry. But they admitted at the end of 2018 they still had not resolved completely that data breach. It was a huge hurdle and a huge payoff. Marriott standardized eval data was exactly the same as their as reported 10K. They were completely the same. There is nothing out of the norm in their accounting practices and how they recognize revenue and expenses. There are some temporary timing differences, however, because they are reimbursed by hotel owners for the expenses they accrue while managing a hotel. Sometimes there is a timing difference as it takes time to bill the hotel owner and be reimbursed. They can recognize the revenue and the expense in different periods. Some of their accounting practices require a large amount of managerial uh, subjectivity and estimation. One of these is the loyalty program, and they discuss in the MD&A of their 10K how difficult it is to stick with GAAP policies in the accounting of this loyalty program, and how many nights they'll have to give free to their patrons. They describe it as a material weakness. Another area is in the area of goodwill. They test it annually and impair it as necessary. And in their self-insurance program, which covers employee costs that go beyond um, the estimated or projected value for medical, workman's compensation, and certain levels of liability. They can accrue the estimated cost at the present value of the projected settlements and they use a discount rate of 3%. But it is still largely subjective. All in all, we believe that their asset, the amount they carry for goodwill on their balance sheet, that asset is too high. With the data breach and the lengthy explanation they gave of how difficult it was to overcome that data breach and to clean up the fallout and how expensive it was to the company, we feel that they should have impaired their goodwill during 2017 and especially during 2018. However, their earnings are a pretty good picture of their financial condition. They showed a large increase in earnings due to the acquisition of the Starwood brand. However, they never marked down their goodwill.
Return on equity is one way to look at the performance of the firm. It is calculated by the net income divided by the shareholders' equity. It also means how effectively the management is using the asset to generate the profit. In this case, Marriott, it has a 0.66 ROE. It indicates that the Marriott's return is 66 cents for every dollar of shareholders' equity. In this slide, it talks about the Marriott's advantage point. As you can see, Marriott's RNOA is 0.19. It indicated that how Marriott is using their net asset to generate income for the firm. It also means for every dollar of net operating assets, the return is 19 cents. For the leverage, it has a number of 3.03. It indicated how the firm used the debt to finance. For the spread, it has a positive number, it's 0.16. It shows Marriott's operating activities are more profitable than financing activities. We chose Hilton as the competitor of Marriott. As you can see for the RNOA for Hilton, it's 0.75. It means for every dollar of net operating assets, the return is 75 cents. It is a higher number than Hilton, Marriott. From our research, we found that the difference comes from because the franchisee of Marriott, they reimburse all the expense to Marriott after Marriott recognized the expense. It brought down Marriott's RNOA. If Hilton would have accounted the expense in the same way as Marriott, the RNOA of Hilton would be brought down by 25%. For the leverage, Hilton has a number of 6.21, which is a higher ratio than Marriott. It also means it's more capable to effectively to use the debt to finance. For the spread, it has a negative number, which is negative 0.01. The negative spread is result of higher NFE, which come from the $5 million minority interest earning. Another way to look at the company financial performance is looking at the margin and the turnover ratio. For the NOA, which indicate how the firm used the assets to generate the sales. In this case, both of the firm have a really similar ratio. Marriott has 1.77 and Hilton has 1.1. For gross margin, Hilton has a way higher number than Marriott. It's even more than triple. From the information we have, for Hilton, the higher gross margin is a result of the cost control of the operation. Therefore, even though Marriott has a much higher sales, Hilton still ends up with a higher gross margin. For the free cash flow to common equity and the investors, here is some basic definition. For FCFE, is the amount of cash a business generates that is available to be potentially distributed to shareholders. For SCFF, it is the cash available to pay the investors after a company pays its cost of doing business. In this case, for Marriott, the free cash flow to common equity is $3,640,000. For the free cash flow to investors, is $2,807,496.67.
So what did Marriott do with all the cash flow? They purchased the treasury stock to the tune of $2,850,000,000, by far their largest deployment of cash. They also had capital expenditures of $556 million, and they paid dividends of $543 million. And they also repaid long-term debt of $397 million.